Hey everyone, welcome to this explainer. So, if you've been keeping an eye on the markets lately, you know things are acting, well, kind of weird. Today, we're jumping straight into the dense, sprawling omnibus market intelligence briefing of July 2026 to decode exactly why the market is behaving so strangely. Let's get right into it. Let's start with a bit of a riddle. What on earth do a $15 pack of Pokemon cards, $9 a gallon Alaskan gas, and a $14.5 billion server cooling company have in common? I know, it sounds totally random. But to make sense of today's deeply paradoxical macro landscape, we've got to look past the surface level data. We need to find the hidden thread tying these wild extremes together. By the end of this explainer, I promise you, that connection is going to be crystal clear. Right now, we're dealing with four massive interlocking forces that are completely dominating the landscape. We're talking about a serious AI reality check, a really intense monetary tug-of-war happening at the Fed, some brutal geopolitical economic lags, and a booming alternative asset market. And these aren't just isolated events, right? They're grinding against each other and completely warping the traditional rules of investing. Thread 1, the tech and AI paradox. Let's see how the so-called cloud is actually getting incredibly heavy and how it's splintering the AI battlefield into two totally different extremes. We're seeing a staggering contrast out there. On one hand, you have loss leader software. Giants like OpenAI and Anthropic are throwing massive compute credits at startups. And platforms like Cursor are practically giving away their products with 75% discounts just to win this digital turf war. But then, look at the physical reality. Solstice Advanced Materials just dropped $14.5 billion to acquire a company purely to dominate AI chip cooling. So while the software is heavily discounted, it's taking literally tens of billions of real physical dollars just to keep those servers from melting down. And this massive physical reality, it's creating what we call an accidental value cycle. And it's honestly fascinating. Here's how it works. The AI infrastructure boom triggers massive earnings spikes for cyclical chip makers. Since they're suddenly making so much money, their price-to-earnings ratios, how much you pay for a dollar of profit, just plummet. This makes them look artificially cheap. So algorithmic value screens start buying them up in droves. The result? Value investors suddenly have highly concentrated tech exposure. I mean, the VLUE ETF is up 43% this year, largely because Micron now makes up almost a quarter of that entire fund.
Tobias Carlyle hit the nail on the head here. He points out that if earnings surge for a cyclical stock, it temporarily looks very cheap. These quantitative screens are just blindly buying the dip in PE ratios, totally masking the true cyclical risk of these massive hardware companies. It's a complete mechanical blind spot for the market. And this valuation anxiety is leading to market reactions that completely defy logic. Take Samsung. They just reported a blowout, 19-fold jump in profit, 19 times. But their shares actually fell 7%. Why? Because the market is absolutely terrified of their Shiller PE ratio creeping up to dot-com bubble levels. They're totally ignoring the reality of a much more reasonable 12-month forward PE. Basically, the fear of history repeating itself is overpowering the reality of actual lasting productivity growth. Moving on to thread 2, the abstraction trap. Okay, so let's pivot away from the heavy physical infrastructure of AI to the exact opposite. We're going to look at how highly abstract paper wealth and alternative assets are behaving in completely unnatural ways. Just consider the wild mechanics of passive indexing right now. SpaceX was just fast-tracked into the NASDAQ 100 at a $300 billion valuation based on its float-adjusted weight. That just means the portion of shares actually available to trade. Now, because there is $800 billion of passive money blindly tracking this index, it triggers a mechanical squeeze. Passive funds are literally forced to buy $6 billion in SpaceX stock, which is 6% of their available shares. It's this massive trading event driven entirely by algorithms that must buy, completely independent of the company's fundamental value. And we're seeing this abstraction trickle down to everyday consumers too, through the financialization of nostalgia. We're now looking at a $100 billion market where buying a $15 pack of Pokemon cards at a bodega isn't just a hobby anymore. People are rationalizing it as a legitimate investment strategy. Driven by these viral million-dollar mega finds, it creates this intense dopamine loop and a behavioral justification to just keep buying. It's essentially high-variance gambling, but it's masquerading as asset management. Even in the crypto space, these abstract models are hitting a serious wall. Look at the mathematical trap of MicroStrategy's Bitcoin hoarding model. For a long time, investors valued the company at a premium compared to the actual Bitcoin it held. The delicate psychology of it all worked perfectly. But that psychology is breaking down. We're now seeing an inversion where the market values the company at a discount to its underlying Bitcoin. The mathematical trap is officially snapping shut. Let's move to thread 3, the consumer reality. This is where things get really interesting, because when we ground this explainer back on Main Street, we see everyday consumers and macro policymakers facing some incredibly harsh, undeniable physical realities. Right at the very top, the Federal Reserve itself is dealing with a very public philosophical schism. As inflation takes off again while the labor market stabilizes, Governor Christopher Waller is advocating for forward guidance, basically using past promises and communication to guide the markets. But on the other side, Chairman Kevin Warsh favors a reaction function. He wants to drop the guidance entirely and make judgments strictly based on real-time, hard economic data. They are literally divided on whether they should manage the abstract future or react to the physical present. And while the Fed argues about macro philosophy, the reality on the ground for everyday consumers is just brutal. First-time homebuyers surged to 35% of all purchases in May, but the barrier to entry is radically fragmented by physical geography. You're not just dealing with national interest rates anymore, you are dealing with hyper-local structural realities. This structural divide is staggering when you actually look at the hard numbers. Entering the housing market in a coastal hub like San Francisco, that demands a 27% down payment, which averages out to about $400,000. That essentially requires liquidating a 6-figure stock portfolio just to get the keys to a house. Compare that to Detroit, where a 5% down payment comes out to roughly $7,600. The abstract idea of a single national housing market simply doesn't exist. Your reality is entirely constrained by where you physically stand. We're seeing this physical constraint in energy too. Take the Alaska paradox. Globally, Brent crude futures have actually dipped to around $72 a barrel. So gas should be cheap, right? But rural Alaskans are structurally trapped paying $9 for a gallon of gas. Why? It's the supply chain time lag. Remote towns there had to place their annual fuel orders during the spring panic when prices spiked. Because of the physical delivery lag, their local economy is stuck paying panic prices all summer long. Physical distance is completely overriding digital market pricing. The grand reveal, the return to the physical economy. All right, let's pull all these seemingly disconnected threads together and see the big picture. Here is the unifying insight, the whole ballgame. Whether it's AI constrained by the actual thermodynamic limits of cooling computer chips, or digital supply chains getting overridden by rugged Alaskan geography, or strategic capital suddenly shifting away from software, the underlying force driving this entire market is that abstract digital value is rapidly colliding with and being constrained by the physical world. This collision explains the sudden dominance of what's called the halo strategy. Goldman Sachs is actively pushing this right now. HALO stands for heavy assets, low obsolescence. What this means in practice is pairing long positions in heavy, physically necessary assets, think infrastructure, basic materials, defense, and utilities, with short positions in capital-light software services. It's a complete fundamental rewiring of how capital is being allocated. Because of this collision, we're looking at a massive CapEx shift. Capital expenditures in data centers, utilities, and defense are expected to represent over 40% of total CapEx in 2026. That's huge. This is forcing the entire global market structure to pivot. It's heavily favoring regions grounded in the physical layer, like Europe, Japan, and emerging markets, over the US, where equities are still precariously concentrated in capital-light software sectors. So, what does this all mean for us? As we wrap up this explainer, I really want to leave you with a vital question to ask yourself. As digital abstraction inevitably crashes into the physical world, is your portfolio built for a capital-light past, or is it prepared for the heavy asset reality of July 2026? Because in today's market, the ultimate luxury and the most resilient asset class is hard physical infrastructure. Thanks so much for diving into the data with me today, and keep questioning what's under the surface.